How do rising interest rates affect U.S. government securities? Have you ever wondered how rising interest rates can impact your retirement investments, especially when it comes to U.S. government securities? Let's break it down in simple terms. U.S. government securities are debt instruments issued by the U.S. Treasury. They include Treasury bonds, notes, and bills. Many people consider these options to be low-risk investments, making them popular for retirement portfolios. When interest rates rise, something interesting happens. The prices of existing U.S. government securities typically fall. This is because new securities are issued at these higher rates, making older ones with lower fixed interest payments less appealing. As a result, the market value of those older securities decreases. This is a key relationship to understand. For retirees or those planning for retirement, this situation has some practical effects. If you own U.S. government bonds that you bought when interest rates were lower, their market value will decline as rates rise. If you need to sell those bonds before they mature, you might find that your retirement portfolio has lost some value. However, there is a silver lining. With rising interest rates, newly issued Treasury securities will offer higher interest payments. This can be a great opportunity for retirees who are relying on income from their investments. When reinvesting maturing bonds or purchasing new securities, you can lock in those higher yields for future income. It is also essential to consider interest rate risk. This risk refers to how changes in interest rates can affect bond prices. Generally, longer-term bonds are more sensitive to these changes than shorter-term bonds. Many retirees manage this risk by holding a laddered portfolio of bonds with different maturities or by focusing on shorter-term securities. Additionally, rising interest rates often indicate concerns about inflation. Inflation can erode the purchasing power of fixed interest payments. Therefore, higher rates may signal that investors want more compensation for this risk. Treasury inflation-protected securities are designed to protect against inflation and may be appealing for retirement portfolios during times of rising rates. Lastly, let's talk about tax implications. Interest income from U.S. government securities is subject to federal income tax but is exempt from state and local taxes. This can be beneficial for retirees living in states with high income taxes. In summary, while rising interest rates can cause the prices of existing U.S. government securities to fall, they also present opportunities for higher yields on new investments. Balancing interest rate risk while meeting income needs is an important part of retirement investment strategies involving U.S. government securities.